Here's something that happens so quietly that most people didn't even notice it. Buried deep within the legal definition of your savings account is a clause that has existed for decades, quietly sitting in the fine print. Most depositors have never read it. Most bank employees will never mention it. And mainstream financial media avoids explaining it because it doesn't fit the narrative they're paid to maintain. This clause gives your bank the legal right to delay your withdrawal by 7 days. Not to freeze it permanently, not to block it forever, but to delay it for 7 days without offering a reason, without creating a crisis headline, and without any public announcement. This is not rumor, and it is not speculation. It is codified in the Code of Federal Regulations under Title 12, Part 204, Regulation D, which governs savings deposits at every bank, credit union, and thrift institution across the United States. The clause itself states that a depository institution reserves the right, at any time, to require 7 days advance written notice of an intended withdrawal from a savings deposit. Those are the exact words. Most people never see them because they never read the documents they sign when opening an account. But the clause exists. It is active today, and it was not written by accident. What this clause represents is more than a technicality. It is a pressure valve, a mechanism deliberately built because the architects of the banking system knew that under certain conditions of financial stress, they would need a tool capable of slowing a system bleeding liquidity without a formal emergency declaration. A tool that works quietly, out of public sight, buying time. What I'm walking you through today is not panic. It is not speculation. It is a quiet procedural sequence that begins with a legal framework most depositors are unaware of, builds through financial stress accumulating silently on bank balance sheets, and ends in a situation where accessing your own money is no longer entirely your decision. I have spent years observing these sequences unfold. The names, triggers, and headlines change, but the mechanics remain consistent. Once you understand them, you stop waiting for headlines. By the time a story appears in the news, the first moves of the sequence have already occurred. To understand where we are today, we must trace the historical foundation. In 1933, the U.S. banking system had been collapsing for 3 years. Between 1930 and 1933, over 9,000 banks failed. 9,000, not weakened, not restructured, but completely gone. The savings of millions of Americans evaporated, not due to poor financial decisions, but because the institutions holding their deposits had no liquid funds to honor withdrawals. The money existed on paper but not in cash. Once depositors realized the bank could not pay everyone simultaneously, a run began, guaranteeing the feared outcome. In response, the relationship between depositors and the banking system was fundamentally redesigned. The Federal Deposit Insurance Corporation was created. Deposit insurance was introduced, reserve requirements restructured, and the very definitions governing savings accounts were rewritten. Regulators wrote in a reservation of rights for banks, the right to require advance notice before releasing funds, not a permanent right to refuse, but a temporary right to delay, a valve designed to relieve pressure when necessary. For most of the next 9 decades, that valve was rarely needed. The system operated within design parameters. Individual bank runs occurred but were quickly contained. The FDIC would step in, make insured depositors whole over a weekend, and the system continued. The valve was a redundancy, like a fire suppression system in a building that had never caught fire. You stopped noticing it. But the savings and loan crisis of the 1980s exposed a gap in the architecture built after the Great Depression. It could handle individual failures but not systemic stress across an entire sector. Between 1986 and 1995, over 1,000 savings and loan institutions failed in the U.S. The Resolution Trust Corporation was created to manage the wreckage, costing taxpayers over $120 billion, and regulators began designing a more permanent answer for crises too large for the insurance fund alone. That answer took full form after 2008. Following the global financial crisis, the Financial Stability Board, which coordinates financial regulation for the G20, published a framework for resolving failing banks. The principle was that the cost of a bank failure should primarily fall on the bank's stakeholders, not taxpayers. This bail-in framework, as opposed to a bailout, is embedded in Title II of the Dodd-Frank Act under Orderly Liquidation Authority in the U.S. While the European Union adopted the Bank Recovery and Resolution Directive, the UK implemented the Banking Act of 2009, and similar laws exist across the G20. The Financial Stability Board coordinates its implementation across 24 jurisdictions worldwide. Here's how it works. When a systemically important bank enters resolution, regulators like the FDIC take control. Shareholders are wiped out first, followed by junior bondholders, then senior unsecured bondholders. If more capital is needed, uninsured deposits above the $250,000 insured threshold can be converted into equity. Not withdrawn, not returned, converted. Depositors become shareholders in a recapitalized institution. Their claim on cash replaced with a claim on equity that could take years to realize and may return only cents on the dollar. This was tested in March 2013 when Cyprus restructured 2 major banks. converting deposits above €100,000 into bank equity, resulting in losses of up to 47.5%. The Financial Stability Board later called Cyprus a proof of concept for bail-ins. These frameworks now govern every major Western economy. As of early 2026, the conditions that make this framework operational are visible on bank balance sheets, and the data is public. At the end of 2024, the Office of Financial Research reported that aggregate unrealized securities losses across FDIC-insured banks totaled $481 billion, roughly 19.9% of aggregate equity at banking subsidiaries nationwide. By spring 2025, as 10-year Treasury yields rose amid renewed inflation and trade uncertainty, the figure approached $500 billion. A Stanford finance professor told Fortune that yields above 4.5% begin causing serious systemic stress, and at 5% become critical. Today, the 10-year Treasury yield is squarely in that range. This matters because of what happened at Silicon Valley Bank in March 2023, and the lessons it revealed about vulnerabilities shared by hundreds of regional banks. SVB was not an anomaly. It mirrored the behavior of many regional banks during the zero-rate era, investing in long-duration Treasury and mortgage-backed securities to earn yield on deposits that exceeded loan demand. When rates rose sharply in 2022, market values fell, losses remained unrealized, disclosed only in footnotes few depositors read. When confidence faltered and large depositors began withdrawing, SVB sold securities to cover outflows, converting paper losses into real losses, destroying its capital cushion. Regulators arrived Friday, and by Monday the bank ceased to exist. The Office of Financial Research confirmed in May 2025 that unrealized losses could make banks vulnerable if further shocks, such as commercial real estate defaults, undermine depositor confidence. This is not hypothetical. It is already building in commercial real estate, heavily concentrated in regional and community bank loan books. Commercial real estate office loan delinquencies reached 10.4% in the second half of 2025, nearing the 2008 peak and rising faster than ever recorded. Regional banks hold roughly 44% of loans in commercial real estate, compared with 13% at the largest banks. Latent distress, loans underwater, but not yet delinquent, could be 4 times greater than formal delinquencies indicate. Banks have not recognized these losses. Extend and pretend practices delay defaults, masking the scale. Over $1 trillion in commercial real estate loans were set to mature by the end of 2025, with pressure continuing through 2026 and 2027. Borrowers must pay, refinance or default. Refinancing at 6-8% on properties down 30-40% in value is mostly impossible, and the extend and pretend window has a hard limit. When it closes, years of accumulated losses must be recognized. From a depositor perspective, here's the sequence. A regional bank heavily exposed to commercial real estate reports elevated loan loss provisions. Analysts flag credit quality concerns. Local journalists pick up the story. Within days, depositors with uninsured balances above $250,000 begin withdrawing funds. The bank's overnight liquidity deteriorates. Treasury teams activate contingency plans, drawing on Federal Home Loan Bank advances. One tool in that plan is the 7-day notice clause, invoked without regulatory order, public announcement, or headline. Customers receive written notice and withdrawals are delayed. The bank gains 7 days to source alternative funding, negotiate with regulators, explore mergers, or prepare for FDIC resolution. From the depositor's view, the notice is the first visible signal, but the balance sheet stress has been building for months or years through unrealized losses, deteriorating commercial real estate performance, and compressed lending margins. To understand why this matters, we need to examine the FDIC's capacity more precisely. A common assumption is that the Deposit Insurance Fund fully backstops all deposits, but the numbers tell a different story. As of the third quarter of 2025, the fund held $150 billion, representing a reserve ratio of just 1.40%. That means for every $100 of insured deposits, the fund covers only $1.40. Total insured deposits number in the tens of trillions, far beyond the fund's ability to cover simultaneous failures across multiple institutions. The FDIC itself is clear on this limitation. The orderly liquidation authority exists precisely because the insurance fund alone cannot manage a systemic banking event. In such a scenario, the bail-in framework activates, recapitalizing failing banks using the bank's own liabilities, including uninsured deposits, rather than drawing on the insurance fund. This is not speculation, it is the law. Uninsured depositors become part of the recapitalization process. The next critical layer is how this intersects with your savings account. When you deposit money, you are not placing it in a vault. You are extending an unsecured loan to the bank. Your deposit is recorded as a liability on the bank's balance sheet, and the bank deploys those funds into loans and securities. You are an unsecured creditor. Your claim on repayment depends on the account agreement, applicable regulations, and in a resolution scenario, the federal priority hierarchy. For balances above $250,000 per institution, there is no insurance backstop. In an orderly liquidation, your claim ranks below derivative obligations, below secured debt, and alongside other uninsured depositors. The timeline and outcome are determined by the FDIC as receiver, not by you. Most people never consider their savings account this way because they never had to, but the reality is clear: your assumption of unrestricted access may not last indefinitely. The pattern connecting 1933, the 1980s savings and loan crisis, the 2008 financial collapse, the regional bank stress of 2023, and today is consistent. Debt accumulates against asset values inflated by debt itself. Interest rate environments shift. Asset values fall. Concentrated loan books at regional banks generate losses. Depositor confidence erodes. The most mobile depositors move first, accelerating stress for everyone else. The sequence accelerates. What differs in 2026 is the legal architecture regulators built to manage the sequence once it becomes visible. The 7-day clause, the bail-in framework active in 24 jurisdictions, and the orderly liquidation authority under Dodd-Frank were designed after 2008 to ensure that depositors above the insured threshold absorb losses that previously fell on taxpayers. This is deliberate policy, documented in legislation for over 15 years. Most depositors simply do not know it exists. The practical implications are straightforward, if approached as a framework rather than a set of instructions. First, verify your actual coverage. Balances above $250,000 at a single institution are uninsured, regardless of apparent stability. Public FDIC tools allow you to check coverage. Spreading deposits across multiple institutions to remain within limits is simple. Joint accounts and retirement accounts are calculated separately. Second, identify assets outside the banking system. Physical gold and silver held privately or in allocated storage exist entirely outside the banking system. They are not subject to the 7-day clause, the orderly liquidation authority, or any bank liability structure. These assets sit entirely outside the claims hierarchy governing insured and uninsured deposits. Global central banks have been accumulating gold at record levels through 2024 and 2025. Countries like China, Russia, India, and sovereign wealth funds in the Middle East are systematically building reserves. They have access to analytics and regulatory insight that allow them to understand exactly what is on the balance sheets of Western banks. They are not buying gold because they expect a collapse next week. They are managing tail risk in a system that is structurally stressed. Silver, meanwhile, trades at a significant discount to its historical ratio to gold and faces supply constraints from industrial demand in solar manufacturing, electric vehicles, and defense applications. Physical silver demand has exceeded annual mine supply, and above-ground inventories are at multi-decade lows. The combination of monetary and industrial demand is unusual, creating simultaneous upward pressure from two directions. Timing and optionality are critical. Reviewing deposit coverage, understanding account legal structures, and positioning assets outside the banking system do not require an ongoing crisis. They require only awareness and proactive action before the sequence starts. Once a confidence event occurs at a particular institution, the sequence is already moving, the withdrawal queue forms, and the 7-day notice may already be counting down. Acting beforehand preserves options. Acting afterward may limit or remove them entirely. Currently, U.S. bank balance sheets carry nearly $500 billion in unrealized securities losses, approximately 20% of total banking system equity. Commercial real estate office delinquencies are rising at record speed, approaching the 2008 peak. Regional banks hold almost half of their loan books in commercial real estate, and latent distress loans underwater but not yet delinquent may be 4 times higher than reported delinquencies. The FDIC Deposit Insurance Fund maintains only a 1.40% reserve ratio above the statutory minimum, insufficient for systemic stress. The bail-in framework is legally active across major Western economies. The 7-day notice clause exists in your savings account agreement today, available to be invoked without authorization, public disclosure, or headline warning. What is unknown is the exact trigger. The bank, the earnings report, the loan default, or an external shock that will convert latent stress into a visible sequence. A Stanford professor studying bank fragility described the system in May 2025 as loaded, not discharged, meaning structural stress is present and awaiting the event that converts it into observable consequences. Investors and depositors who survived the crises of 1933, the 1980s, 2008, and regional bank failures in 2023 were not those who reacted fastest to headlines. They were the ones who understood the structure in advance, who read account agreements, and recognized that hidden clauses were not footnotes. They were deliberate features, usable tools. Depositors who understand this framework today are not pessimists. They are informed actors operating with clarity about the environment they inhabit. The architecture, the bail-in framework, and the 7-day clause matter not because they will inevitably be used, but because they exist, defining the lowest cost and legally sanctioned mechanism to resolve systemic banking stress. Awareness, preparation, and accurate understanding are the only protection outside the system itself. Acting on this knowledge does not require a crisis to justify itself. It requires recognition of the rules that govern the structure you are in. This sequence does not resolve in a single news cycle. It unfolds over weeks, months, sometimes years. Each stage leaves traces in regulatory filings, call reports, quarterly earnings notes, commercial real estate maturity schedules, and subtle signals in Federal Reserve balance sheets. By the time the public perceives stress, the initial moves have already taken place, and the 7-day clause may already have been invoked without public awareness. The next layer that financial commentary often misses is why the 2026 environment cannot be resolved as in the past. In every prior crisis, sufficient fiscal and monetary capacity existed. In 1933, the FDIC itself was the backstop. During the 1980s, the Resolution Trust Corporation had federal funding. In 2008, TARP and Fed balance sheet expansion stabilized the system. In 2020, zero interest rates, $4 trillion in Fed asset purchases, and massive fiscal transfers provided the solution. Today, the federal debt exceeds $36 trillion. Annual interest obligations are enormous. The Fed's balance sheet remains historically high at over $7 trillion, and inflation is still above target. Monetary and fiscal tools are available but far more constrained. Bail-ins are now the lowest cost, legally sanctioned method to stabilize the system. They require no new congressional authorization, no taxpayer money, and leverage the bank's own liability structure, converting deposits, bonds, and equity into recapitalization tools. From a depositor's perspective, the implications are stark. Your savings account is not a vault. Deposits are liabilities on a balance sheet, subject to legal frameworks designed to protect the system first, depositors second. Insurance coverage caps at $250,000 per institution. Balances above that are unsecured. Understanding this distinction is essential to preserve financial flexibility before a sequence unfolds. Physical assets outside the system, such as allocated gold and silver, are entirely outside the legal architecture. They cannot be delayed, converted, or absorbed into a recapitalization. They remain fully under your control. Global trends reinforce the urgency. Central banks are accumulating gold at unprecedented rates, and sovereign wealth funds are actively increasing reserves. They are not speculating on an imminent collapse but managing tail risk in a stressed system. Silver is simultaneously constrained by industrial demand and low inventories, a unique situation where both monetary and industrial factors push upward. The window to act is before a confidence event triggers the sequence at a specific institution. Once it begins, the withdrawal queue forms, and the 7-day clause could already be active. Awareness and timely action preserve options. The final piece to understand is how the sequence unfolds and why timing is everything. The next developments are not dramatic predictions. They are disclosures already embedded in regulatory filings, earnings reports, and balance sheet notes, quietly waiting to surface. The FDIC quarterly banking profile, regional bank disclosures, commercial real estate maturity data, and call reports all provide incremental signals before they become headlines. By the time the public perceives stress, the first moves have already occurred, and the 7-day clause may have been invoked without anyone realizing it. Observing the system without understanding these rules is very different from following it from a position deliberately chosen because you read the fine print and recognize the structural and legal tools built into the system. The 2026 environment differs fundamentally from previous crises. In 1933, the FDIC was new and adequately funded. In the 1980s, the Resolution Trust Corporation had federal backing. In 2008, TARP and Fed balance sheet expansion stabilized the system. In 2020, zero interest rates, $4 trillion in asset purchases, and fiscal transfers acted as backstops. Today, the federal debt exceeds $36 trillion. Annual interest payments surpass the entire defense budget. The Fed's balance sheet remains historically high, and inflation is still above target. Monetary and fiscal interventions are available but at significantly higher cost. Bail-ins are now the most efficient, legally sanctioned tool for managing systemic banking stress. They require no new taxpayer funds, no extraordinary balance sheet expansion, and they leverage existing legal structures, converting deposits, bonds, and equity into recapitalization tools. From a government perspective, bail-ins are low-cost, immediate, and fully compliant with existing law. From your perspective as a depositor, the implications are clear. Your savings account is not a secure vault. Deposits are liabilities on a bank's balance sheet, governed by regulations designed to protect the system first and depositors second. Balances above $250,000 per institution are uninsured, leaving excess deposits exposed in a systemic event. Understanding this distinction is essential to maintain financial optionality before a sequence begins. Assets held outside the banking system, like allocated gold and silver, remain fully under your control, unaffected by the 7-day clause. the orderly liquidation authority, or any other regulatory mechanism. They sit outside the claims hierarchy that governs everything else discussed here. Global trends reinforce the importance of this awareness. Central banks and sovereign wealth funds have been systematically acquiring gold through 2024 and 2025. Institutions in China, Russia, India, and the Middle East are building reserves with access to analytical tools and regulatory insight, allowing them to understand precisely what is on the balance sheets of Western banks. They are not speculating on imminent collapse. They are managing tail risk in a structurally stressed system. Their strategy is rational: hold assets that cannot be delayed, frozen, or converted into equity. Silver, in contrast, is constrained by industrial demand and historically low inventories, creating a rare situation where monetary and industrial pressures converge, placing simultaneous upward pressure on the asset. Timing and preparation remain critical. Reviewing deposit coverage, understanding the legal structure of your accounts, and establishing positions in assets outside the banking system do not require an active crisis. They only require accurate awareness and proactive execution before a confidence event triggers a sequence. Once the event occurs, the queue forms, the 7-day notice may be counting down, and options become limited. Acting in advance preserves control. Acting afterward risks losing it entirely. Today, U.S. bank balance sheets carry nearly $500 billion in unrealized securities losses, roughly 20% of total banking system equity. Commercial real estate office delinquencies are climbing at the fastest rate ever recorded in this series, approaching the 2008 peak. Regional banks hold almost half of their loan books in commercial real estate, and latent distress, loans underwater but not yet delinquent, may be 4 times higher than formal delinquencies indicate. The FDIC Deposit Insurance Fund, with a 1.40% reserve ratio above the statutory minimum, is not sized to handle systemic stress. The bail-in framework is legally active across major Western economies. The 7-day notice clause exists in your savings account agreement, ready to be invoked without authorization, public announcement, or headline warning. What is unknown is the precise trigger: the bank, the earnings report, the commercial real estate default, or an external shock that converts latent stress into a visible sequence. A Stanford professor studying banking fragility described the system in May 2025 as loaded, not discharged, meaning the structural stress is already present and waiting for the event that transforms it into observable consequences. History provides the guide. Investors and depositors who survived the banking panics of the 1930s, the savings and loan failures of the 1980s, the 2008 financial crisis, and regional bank collapses in 2023 were not those who reacted fastest to breaking news. They understood the system beforehand. They read account agreements, recognized that hidden clauses were deliberate features, and acted proactively. Depositors who understand the system today are not pessimists. They are informed actors, operating with clarity and precision. The architecture, bail-in framework, and 7-day clause matter, not because they must be used, but because they exist. They define the lowest cost legally sanctioned mechanism for resolving systemic banking stress. Awareness, preparation, and accurate understanding are the only tools to preserve control outside the system itself. Acting on this knowledge does not require a crisis. It requires recognition of the rules governing the structure you inhabit. This sequence unfolds slowly. It is methodical, stepwise, and deliberate. Each stage leaves traces: regulatory filings, call reports, quarterly earnings, commercial real estate data, Federal Reserve balance sheet updates. By the time stress becomes public, the first moves have already occurred, and the 7-day clause may already be active. Observing the system without understanding the rules is vastly different from following it from a position deliberately chosen because you understood the legal, structural, and procedural mechanisms in advance. The 2026 environment cannot be resolved like past crises. In 1933, the FDIC was a backstop. In the 1980s, the Resolution Trust Corporation had federal funds. In 2008, TARP and an expanded Federal Reserve balance sheet stabilized the system. In 2020, zero rates, $4 trillion in Fed asset purchases, and fiscal transfers provided intervention capacity. Today, federal debt exceeds $36 trillion. Interest payments are enormous. The Fed's balance sheet remains historically high, and inflation is still elevated. Monetary and fiscal options are constrained and costly. Bail-ins represent a legally sanctioned, low-cost, immediate mechanism to stabilize the system without taxpayer funds or new congressional authorization. Practically, this means systemic stress could result in deposits above $250,000 being delayed, converted into equity, or reduced, according to pre-existing legal rules. Understanding this reality differentiates proactive depositors from reactive ones. Acting before a sequence triggers preserves options, while waiting risks losing them entirely. The video concludes not with a prediction, not with a timeline, but with an accurate depiction of the system structure. The sequence has begun, but does not yet have an end. Observing, tracking, and understanding regulatory filings, call reports, and quarterly disclosures allows you to follow the sequence before it becomes widely visible. The choice is yours. Watch from inside the system, unaware of the rules, or from a position deliberately chosen because you understood them in advance. The next stage is not hypothetical. It is already embedded in filings, notes, and regulatory frameworks, quietly waiting to emerge. Your ability to act before it affects liquidity depends entirely on understanding the architecture, the 7-day clause, the bail-in framework, the FDIC's limits, the structure of your deposits, and assets outside the banking system. Awareness, clarity, and timely action are your tools. Headlines, panic, or narrative are secondary. They simply reflect what has already been set in motion. This is the system you inhabit. It was built deliberately, documented publicly, and is legally sanctioned. The sequence has a beginning, continues with observable financial stress, and will unfold in the coming months. The next data points will appear in FDIC reports, regional bank disclosures, and commercial real estate updates. Watching these signals before headlines arrive is the only way to maintain control in a system designed first for stability, second for individual depositor claims. That is the reality of 2026. It is not fear, it is clarity. It is not speculation, it is documentation. The structure exists, and the sequence has already begun.